Hyprop has reported double-digit growth in its South Africa and East European portfolios. The listed property group lifted its dividend nearly 10% as earnings beat guidance. Hyprop CEO Morné Wilken joins us now for more on the year that was. Thank you so much for your time, Morné. Let's actually start off there with the distributable earnings per share that did exceed the previous guidance that was given. I do know that there was a little bit of a distortion after the accelerated book build due to the 19 million shares that were issued. So just give us insight then into the appropriate reflection of Hyprop's performance.
If we look at distributable income per share, I think we must look at the 90 million of additional shares that was issued. We did say in our pre-close we adjust our guidance to -1% to 2%. We did perform 2.3%. But if you really go and do a weighting on those additional shares that was issued, which is maybe the better way to look at it, our distributable income would have grown by 5%. So that is very much in line with our initial guidance we've put out of 4% to 7%. So we did 5%, but we thought we will rather use the conservative way of doing it as we've done it before, and therefore we stuck to the 2.3% growth in distributable income.
Okay. We'll just highlight then the pillars of your growth. And I mean, you're operating, in an unstable and unpredictable macroeconomic environment. And it would seem from the numbers that had no bearing on your operations. Would you say that your operations were shielded from the kind of challenges that we are seeing in the macroeconomic environment and the strain that the consumer is going through at this point?
Quite right. What we've been focusing on our portfolios, and that's both in South Africa and Europe, is to reposition our portfolios so it talks to the shoppers. Because if you get it right, that the shoppers comes to your shopping center, the tenants will start trading well, and when the tenants trade well, they actually are able to pay better rentals. And as you could see, our tenant turnover on our portfolio has grown substantially over the last 5 years. For South Africa, just for the last year was about 5.5% growth in tenant turnover, and in Europe it was about 6.1%. And I think that hard work we've done over the last 5 to 6 years is starting to pay off, and we actually are seeing it with positive reversions in terms of our rental growth. And I do think, although the economy is in a tough situation, I do think if you've got a competitive edge on your shopping center, people will rather come to your mall than maybe one of the competitors' malls, and therefore, although the economy is tough, there's more people coming into your malls.
All right, and I mean, just with that, tenants coming in, it's pretty encouraging to see those positive rental reversions. In terms of your occupancies and vacancies, are you at comfortable levels?
Yeah, we are. I think our vacancy has increased a little bit on our South African portfolio. That's about 4.3%. And that's mainly due to the right sizing of acres in our portfolio as well as Pick and Pay. But what it does give us is more flexibility to actually bring in other tenants and talk again to what our shoppers want. So I think it's quite beneficial at the end of the day. It is still well below the market. I think at that levels, we're still well below market. In Europe, actually, we only got vacancy of 0.1%. So that's a little bit, that's not much.
Yeah. Well, actually, just talk to me about the runway in Eastern Europe as well. I mean, of course, we did see this exceptional performance in this reporting period. Are you looking at that momentum accelerating even more?
Yes, definitely. I think what is a big advantage, we just recently got approval, what they call in Europe, COOP approvals. That's actually getting additional rights to make your malls bigger. So we've been trying to get those rights in place for the last 3 years. And now we eventually got it, and that will give us the opportunity to expand those malls. And when you expand it, you will actually see some organic growth. And I'm quite positive about that. In South Africa, we've been also driving quite a lot of the organic growth, specifically on our portfolio in the Western Cape. Somerset Mall, we're busy extending by 5,500. So all of that, I think, is going to count positively of making our malls just stronger.
All right. Well, let's get into that balance sheet. I, of course, see that you have reduced your debt levels. Is Hyprop planning on giving itself any more relief through debt reduction?
I think we will always make sure the balance sheet is strong enough. Our internal level we would like to be is around 40%. We're currently at 33.6%. So it gives us a bit of headroom to actually pursue new growth opportunities. And over and above that, we also got about 1.6 billion of cash to look for new opportunities. So we are quite comfortable with that. What we have been doing actively is reducing our Europe LTV as well. Our Europe LTV, we successfully reduced to 43%. We would be more comfortable if it's below 40%. And as we said in the earlier presentation today, we think about 2 years' time, we will be sub 40. So then we're quite in a good position on both fronts, as in SA as well as Europe, as well as on a consolidated basis.
Well, talking about that headroom in the balance sheet and your growth ambitions as well, and of course, you know, with the capital that you did raise from the accelerated book build, I'm wondering, you know, how are you navigating then investment into organic growth, but also how your appetite, or what your appetite for acquisitions looks like right now, particularly after you were not able to reach a deal in terms of a takeover bid for Mass?
Yeah, I think we actively parallel with the Mass transaction, which we were pursuing. We were still actively looking, the team in Europe were actively looking for malls, and we are pursuing 2 opportunities at the moment. It's quite in the beginning stages. We haven't got any progress so far, but it looks very positive. Those assets fit quite nicely in what we want to achieve in Europe, and we will definitely buy assets if we can. What is also good about our share price that has come back quite nicely, we always have the opportunity, should we not have enough debt or enough cash, we could always do a vendor placement to do those acquisitions.
Well, thank you so much for your time, Morné. We do have to wrap up the conversation, but much appreciated. That was Morné Wilken, CEO of Hyprop.